Welcome to the Foundation for the Study of Cycles. We have Monday, we have Cycles TV. Time for your dose of cycle analysis. Thanks for joining me today. We are live. I see you're already there in the chat section. Welcome to another episode of Cycles TV. What a week! What a week it was last week. I hope you have participated in all the great events. We had 3 days of fantastic talks and presentation of one of the most valuable cycle analysts out there. So I hope you have been there. I see already questions coming up in the chat. So the summit will be available if you have registered for the link, and we will share the recorded versions on time with you once they are ready and prepared. So I hope you enjoyed the, last week. I did. So what's up for today? As you know, we meet here to discuss current status quo of cycles in different markets. So today, I want to give you an update on the consumer price index and inflation and cycles on inflation. It's an interesting update. We did this here in May, first time, once the high CPI figures have been reported. We did a cycle analysis on that. Now we have 8 weeks. After that, we have new inflation data out, so let's review what the cycles tell us on inflation. And just as it was requested, or anyhow, it makes sense to have an update on the tech sector. And if we have a look in the tech sector, there's always this interesting, I'd say, ARK Innovation ETF, which at least has been very famous and has become very infamous. But let's check the cycles on this data set. So I think it's interesting to also discuss that. So these are the two topics I will give you an update on today. And always be aware, this is an education session. We don't do any advice, any recommendation. We don't do financial trading advice here. We just do cycle analysis based on digital signal processing on the one and only purpose of detecting cycles in data set. This is no recommendation whatsoever. It's pure education. So please follow this guideline here. So I hope you will learn something from today. Before we start, I need to share, just out of fun, I need to share this with you. There was a great, interesting slide I found just sent over from a friend. There are no gurus, just cycles. I don't know what's the real source of this picture here. I just received it from a colleague and friend in cycle analysis, and I just liked it so much. I wanted to share it here with you. I think it speaks for itself. Okay, so let's get into it. Let's start with the update on inflation, consumer price index data. The June data is out. So let's check on our cycle scanner what this scanner would tell us. And yes, there are no gurus on inflation, only cycles. It's a good statement to start every analysis whatsoever. Okay, here we have the updated consumer price index in our cycle analysis application. As you are aware of, we have the latest figures here now from June, where we reached the 9.1 in regards to the yearly figures. So inflation really pushed up here since May last year. So always the question is this now the end? Or does it will still move more upwards? Before I will go into this discussion, I would recommend, or if you're interested in some previous analysis, I have linked the previous analysis we did here in May. Once it popped up to 8.6, we did the first cycle analysis. And this analysis back in May, you can review it on your own, showed us that it has not peaked at least in May, that it was the analysis we have seen in May, that this was not the peak at 8 point something. Now we are at 9 point something. So from May, we again have been spot on in predicting rising consumer price index by another percent, or approximately 1% on top of what we've seen in May. So this has been spot on. And we also, the cycle back in May also suggested that we will reach the top this year. So it would be interesting to see if this is still the case or if the cycles might have changed. And if I'm talking about the cycles might have changed, this is due to the reasons that cycles are never static. Cycles change due to their inner nature in regards to their phase, their length, and their amplitude during time. So that's the reason we always need to recheck the status of dynamic or current cycles in the market data. That's what we do now with the consumer price index. So what we're doing here is a standard procedure. If you're a long-time follower, you will know what we're doing here. So we just first go down into the spectrum and check what the spectrum tells us here. In the spectrum, we look for the most prominent or sharpest peak we can observe in the spectrum. And a sharp peak means that we want to see a clean peak, so a clean pop-up in the spectrum as best as possible, not a flat one. So here on the right-hand side, so what is a good, what is a bad one? So let's start with the bad one. This is a bad peak. I'm just highlighting here because it's a very flat situation in the spectrum. There seems to be a peak, but it's not exact where the length is. If you look at the axis here, the peak could be somewhere in this range here, but we don't have a clear peak on the spectrum. From a mathematical point of view, the analyzer will tell you there is a cycle, but it's just a flat peak in the spectrum. Therefore, it's a bad peak here. So not using this one. On the other side, we have a good peak here, which stands out clearly in the spectrum here on the left-hand side. So it's a shorter range cycle we can see here. I've just highlighted it here. And this one is a good one because it clearly stands out. It's separated from the left to the right. It's a sharp peak, and the amplitude is very above so the next level of amplitude is somewhere here. So it clearly separates in regards to amplitude from the other cycles. And it clearly separates and is a very sharp peak, as you can see here. So this qualifies this peak as a very important peak to use for cycle analysis, cycle forecasting. What's the purpose of what we are doing here? So I hope this gives you a quick example on current data set, why to pick this one. So if we check this cycle here, it has a length of 64 month here. We need to be careful. This is monthly data. So the consumer price index, the source is the Federal Reserve of St. Louis. So it's not a symbol you can directly use. If you want to use this, I have just used the FRED data source, monthly data, but you need to download it manually and then upload it into the scanner. It's just a download from FRED. Federal Reserve Bank of St. Louis provides CPI data figures. Download it, upload it, that's it. So you can do on your own. And then you have the monthly data here. So 64 month is the dominant cycle, which has good strength, good Bartle score, which is the first cycle we should select for cycle analysis. So therefore we go up into the list here on top of the chart. It's also listed here on top, so 64 months. Let's activate this cycle here and let's have a first cross check. Just checking the historical view on this data. I mean, if we go back here, we have data, and that's interesting here, we have data back to 1952, which is a very long period for cycle analysis here. So just now quickly, and I repeat this every time, but it's important that you understand the procedure here. The first important thing is to validate if tops and bottoms on these cycles here, so here's the top, here's the bottom, more or less correlate to the real price movements of the consumer price index, because we use cycles for timing. Don't read the amplitude of these cycles for any price projections. This framework of cycle analysis is used to identify points in time when the change in trend reverses here. So here we have the low, which is a projected low. Here we have the top, which is aligned with this one here, so we can connect this one. So here we have a low, here is the high. I mean, this was a flat period here. Here a low, so then here, which is a good alignment here to the top here and the top here, and a low here with a low here. Then very clear high here, and then very good alignment between the low here in 1977, and then the peak here in 1980, which can connect here. And then again, the low here at this point, which is aligned then here. So this length of 64 weeks has a very nice correlation with past major tops and bottoms. Here's a flat period in the markets, but here you see the low aligned here with the low, and the next top here is here. It's very close to this timing here. So then here's another low exactly at this point in time. Here the top aligned here. So then here the lows clearly seen. Here the top clearly aligned with this timing here. So here we have a low. Here we have top, which is then here. Here we have clearly the low again. So now, and here we are. So first of all, and that's what I always recommend if you analyze this kind of data set. If you have a good fit or match, fit. Okay, it's a new term. Should we invent a new term? You have a good Fitch score. A Fitch score. Maybe we should invent a Fitch score. Let's have some fun on cycle analysis. But without kidding, it's important that you get a sense of the correlation of market turns, so changes in trend, which should be in alignment with the projected tops and bottom of the static cycle, which is just plotted as an overlay here. So that's what I call good fit, a good match, or a so-called Fitch score. I like this term. Because we are not talking about the real correlation, because the correlation would also take into account the amplitude or absolute price movements, which are not interesting here. So we are not interested because the cycle has a static amplitude. We are not projecting the absolute price swings. We are just looking for points in time. Therefore, it's not the exact correlation which you might think from a mathematical point of view. But that's it. So again, and that's the same cycle we have seen in May. So therefore, if we now switch back, including the data, if you compare this with the analysis back in May, the cycle, I think it had changed by 1 month. So it changed from 65 to 64 months now as a dominant cycle. But the current phase, and we can now zoom in here in the current projection, what I'm doing here, has not changed. So, and now the updated projection, I mean, projects the high in the consumer price index on inflation to be reached now in July, so this month or now. So in May, we made a good proposal that this is not the final top, and we made a bold statement back in May because everyone think, okay, inflation should not go higher. So at least, and this is a very long-term cycle, if you read it in terms of month, July might be now, or the summer this year, I would not give it the exact months here, but the summer period now should mark the high of consumer inflation, at least pointing from this major dominant cycle here. If you analyze the past data, you also see more in this analysis, because, and this becomes obvious once you analyze more and more data sets, the cycle bottoms are in most cases more exact than cycle tops. But however, as we can go back for over 50 years with this single cycle, it's not a composite cycle of however much cycles you can use, it's just one single cycle going back until, and you see the peaks here in the year of 1979, 1974, the low of 77, the low of 72, which is over 30 years, 50 years ago. And how perfect this cycle has been in swinging or at least showing the rhythm of inflation. And if this rhythm, I mean, that's just pure cycle analysis, if this rhythm is still active, the low was here in April 2020, and we should now reach the high summer this year, and then another period starts until 2025. That's the update on the consumer price index and inflation. And I think we have a valid prediction here, as the cycle is more or less the same since May. It's an interesting period we are in. As always, this is not any forecast or financial projection. This is pure cycle analysis. Please now add shorter term measures and additional technical analysis measures here. So again, if you have questions on that subject, let's get into it. So Dale, you had the questions, what is the symbol for this data? I tried to explain it already during the session. The reason you can't, I mean, we have access, first of all, it's from the FRED data source, Federal Reserve Bank of St. Louis. They have free API data, which everyone can use for free. We have a wrapper for that. However, we can just load weekly or daily data. So therefore, we cannot directly access this data from the cycle scanner. This will improve in the next release. So if you want to analyze monthly data, which the CPI is, you need to download it manually from the FRED data source and then upload it into your account to analyze it, as I did here. So same procedure. So hope this helps here. So that's on the inflation topic. So you can throw in your questions on other subjects. I will get back to the general questions at the end of the session. So second topic, let's have a look at the tech sector, cycles in the tech sector, and in addition, just to the ARKK Innovation ETF, one of the most prominent ETFs, ARKK Innovation ETF, yeah, exactly. So therefore, we can grab this data. So the ARKK Innovation ETF is available, for example, via Yahoo Finance. Just look out for the symbol on Yahoo Finance, and you can use the same symbol to just load up this data via the cycle scanner, which will I do now with you in our next chart here. So what we see here is the ARKK. No, this is not. Yeah, it is. It is. That's the. You see it here in the symbol chain. This is the symbol to grab the ARKK Innovation ETF with daily data. And if we just have a look here, what a ride it has been from 160 in February last year down to below 40 now. And it's a ride on both ends. So I mean, I know it was hyped, or you also know it was hyped here in April 2020. Yeah, it was hyped here. It did shoot up, and it has now lost interest and going down more bust from 160 down to 40. I think it was the best ETF and now it's the worst ETF, and all this changed within 2 years of its life. So that's how risky investment and trading, by the way, is. What we will now do here, let's have a look on cycles within this data set. So therefore, let's first load more data into the scanner. So I think it was, the first data we have is 2014. It's due to the fact that the ETF, I think, was born there, or it's the first day we have information from this ETF, which has then outperformed, I think, even the Nasdaq and the tech sector, then shooting up and now going down. We need to be careful, as from a long-term perspective, we don't have enough data to judge this data set. It's a very, very new data set, and you always, if you get into some new data sets like this, you should always start with a longer-term historical analysis. And maybe explain first, if you are new to this form of analysis, there are two general ways I would recommend everyone to start or do cycle analysis on an asset class. First, do a long-term analysis with lots of data to check what the average cycle in this data set is or was. And then you can go in clusters through historical phases or time periods in this long-term data set to see if the average cycle comes again to be visible or not. So, and often, or what a good case would be, and if you will be able to find in the historical analysis some kind of nominal cycle length, which shows up more often than others. This will give you some confidence that some cycles with a specific length, around a nominal length, are some kind of rhythm in this data set. Sometimes they might disappear, sometimes they might change their length a little bit, but from an historical long-term analysis, they show up again and again, and then you should analyze if they have been visible prior to important market turns. That's how I always start with new assets or asset classes I'm not familiar with, to start with a long-term cycle analysis. You could view my video on Bitcoin. I think I did last year, not the actual one, but last year. Unfortunately, we can't do this with the ARKK Innovation ETF. Then the second form of analysis is you want to do an actual projection, an actual outlook into the future based on your analysis. And there it's important, don't use a long-term data set and a long-term analysis to do projections from the detected cycles from the long-term analysis, because you just have a kind of average on nominal cycles in the data set. These nominal cycles should not be used in your current forecasting. If you do, or if you want to do current forecasting, you need to know the actual length of the cycle at the current point of time, not the cycle lengths 2 years ago, 5 years ago, or 10 years ago, or on average within the past 50 years. What's the cycle length today? What's the phase of the cycle today? That's what we're interested in. And therefore, just use the minimum amount of data you require for that. And the rule of thumb is just use 3 times the longest cycle lengths you want to detect. If we're dealing with daily cycles, 300 multiplied by 3, you are getting a length of 900 as the maximum historical data to use if you want to analyze the current cycle status quo. So enough said, and please excuse if you heard this several times, but that's important. Therefore, let's limit our analysis here to 2018. I will update the cycle analysis somewhere here. That's 1,000 bars. That's okay. Around 1,000 is okay. We need to be careful here, as we might not have enough cyclic movements here in this data set, and one very prominent cycle here. So, and not enough long-term data. So therefore, it's just for fun. But standard procedure first. Let's have a look into the spectrum. This is the spectrum. There is one cycle showing up in the spectrum, which is 213 trading days. And by the way, these are trading day charts. It's also often another question. It's just the pure data or the raw data as it comes from the trading environment. It is not adjusted to daily, continuous daily charts. We can do this, and this might be something I want to recommend and show you in a second. But for the purpose of this study here, we have a prominent cycle of 213 days in the ARKK Innovation ETF. And always the same procedure. It stands out in the spectrum. I mean, it's separated from left to right. It has a green triangle, which means it has a good Bartle score. And it has a very large triangle, which means that also the strength is good of this data set. So we will move up, and we see the cycle here also in the list on the right. You see it here, 213 days. Strength is 1.62, Bartle score higher than the other two ranked ones. So the highest Bartle score overall was 77, which means this is the cycle to choose in that case here. So as always, let's have a cross-validation in regards to the timing in our historical point of view. So therefore we can make this even a little bit better visible, and I will go over it with you now here. So here is the previous top, which is exactly in line with this top here. That's fine. We could argue this low here is then in sync with this low here. Could argue this top somewhere here, the top in the data. So then here's a period with continuous up move from, let's say this top is exactly this top here. That's okay, but then between these two tops are very, very exact here. So this one here and this one here. However, the low is really off. So yeah, no, then we can't detect the low. So, but the top was on here. So this low then again is very good aligned with this one here. So then we have a clear top here again with this local top here. And then here it's, yeah, there is a top. You need to see this as a relative changes in trend. And here the low, yeah, this is the bottoming period here. We have a low here and we have a low here, which is in the allowed period here. So yeah, if you want to connect it, something like, yeah, then we have sideways movement into, so this downtrend here, no, there's nothing to see here in between. So this was a very strong up push here, and then, but then the swing has getting back into sync, and we are now here. And this sideways period here from the low is now this period from the low to where we are. So this was a projected upswing here from this cycle, and the real data or the real innovation ETF just moved sideways in this data set. So that's the current analysis here. If we just do a very quick and rough visual inspection of this cycle here. The reading now in terms of where are we in this cycle here? I mean, you could also see a larger cycle, which is a harmonic of this cycle, which is going from this low to this top, and then going back exactly here. So this is a harmonic cycle, and then going down here. Maybe it's not as clear, but if you are familiar with cycle analysis, this is just an harmonically related cycle to the 200 something, 213, which is not visible here on the daily chart. So it's then 425, something like that. if you multiply it by 2. So that's an harmonic relation. I see it visually. It's not in the table here, but this could be interesting if you want to analyze it. Again, I will show it to you. So from this major low here to up to this top here, and then again down to where we are here. So this seems to be then the next upswing in place, and this would recommend it to here and then going down. There is a cycle, but I think not enough data, not enough historical validation in regard, and a too prominent single move showing this here in the data set. We don't have enough repetitions in the past of a cycle with a length of 400 something, or we need to move over to a weekly chart. And we can do this, but then you will see what I'm talking about. If we switch over to a weekly chart, we just don't have enough data here. So the amount of data we just have on this weekly data set are 400 bars, which is really not enough to do a long-term analysis on a weekly chart. So that's it. However, it is at a bottoming phase, and the current upward cycle is just, it has stopped the downward trend, to say it this way. So maybe in a negative environment, we might now see a sideways movement of the tech or the innovation related asset classes. If the environment, because you remember we are always, we are still in a negative long-term downward cycle phase. So a long-term downward cycle phase now with a positive innovation cycle is resulting in a sideways move in the innovation asset class. So we never know which is more strong now. If the bullish innovation daily cycle might overrule the long-term negative view into early next year, which is still a valid long-term cycle in the global markets. They have been in sync until April, so this resulted in a sharp drop in the ETF here. So in this phase, we had both cycles in alignment. Now the daily cycles switched to a positive situation, which since you see it here since April, resulted in this bottom sideways move. So we just need to observe how the environment now changes, and if a long-term or short-term cycle will get more prominent in this data. So therefore, this was just more or less fun analysis in the tech sector. Again, there are no gurus, just cycles. I just like the statement for today's show. I don't know the real source, so if you know it, please let me know. And bear with me that I'm just using this statement. If you want to dig more into the tech sector, please also analyze the Nasdaq 100 and other tech indices we have out there. So I will also do this next week. Once we meet here, we will have a more deep dive in the global markets, so the S&P, the tech sector in detail, which then we will see is in alignment with the innovation ETF or not. But that's another 30-minute session. So for today, I would close it with the update on these two data sets I promised here: inflation, ARKK, tech sector, with the caveat I mentioned because due to the very new data set. And now let's get to your questions in the live chat to check out. Let me cross-check just your questions. So maybe here's a question. Sandy22, when you get a strong fit in the field of view, does the projection of the cycle give indicative price target? No, there's a clear answer, no. What we're showing here is a digital signal processing on the time series or frequency domain, transferred to time, which gives us indication on the major turning points in regards to time, not price. There might be situations when it is the case, but this requires more knowledge on the analysis and the projection. So the simple answer and guideline to follow is, even if there is a strong fit between the amplitude swings, it is not giving a projection in regards to indicative price targets. Sandy, but if you want to use cycle analysis also in regards to projecting price targets, I highly recommend to review our session we had last week with Peter Eliades. He is using cycle analysis and a special form of that to derive price targets based on current swings on the real data set. And this would be a perfect alignment if you do time cycle analysis like we discuss here. Bundle it, for example, with the framework Peter Eliades is sharing here at the foundation. And to be honest, mainly it's like the Hurst future line of demarcation, which he is using and is his technique for years. This will give you a price target based on cycle analysis. Okay, so I hope this helps, Sandy. So having cycle alignment between weekly and daily looks to be a strong indicator for future price movement. Yes, that's what we always try to repeat and show here. Does the same apply between daily and intraday? Very good question. And here the answer is yes. Yes, it does. And I would highly recommend, if you are looking for shorter time periods, or if you want to fine-tune your real entry and exit, even on the daily time frame, you can do the same procedure, and the same procedure works if you go down to shorter time periods. So for example, even if you're interested in a daily and just want to fine-tune more exact the exact point to enter or exit some of your trades, for example, use 4-hour chart, 2-hour charts. You don't need to go into the intraday details or very low time frames. Just a 2-hour chart would help you to get in sync between the daily and the 2-hour cycle. And this helps you then maybe to find the exact day, because a daily cycle will not give you the exact day in advance. It will show you a window of days where you would expect a low or a top. If you then switch to 2-hour charts, this will give you more exact, the exact day of a top or bottom once we approach this projected window. So, and this, you can drill this procedure down even on lower time frames. So if you're really on intraday cycles, trading intraday, you can use the daily just to check where the current cycle phase is. Like the long-term cycles I use weekly for daily charts. You can use the daily as a long-term cycle for intraday current status quo, and then go down to 5 minutes, or I would recommend 20 minutes charts. So if you're really in intraday trading, I recommend 20-minute charts for cycle analysis. This works. It works really well. If you go below 20 minutes, the current experience is that it gets too noisy. And the shorter the time period will go, the harder it will be to separate real dominant cycles. But the 20 minutes works. So for example, you can use daily, 2-hour, and 20 minutes if you're really in intraday trading. So Sandy, yes, a good observation, and this works. There's another point here, Eric. Sorry, your name is not shown in full, but Eric, that's your question. Can I correct it quickly? No, not on the fly. With the inflated, deflated prices, and it's a good point, we have kind of a manipulation on the prices here for many shares and indices, which often dwarf the prices over years or decades ago. That's correct. Would it not better to present the charts on a semi-logarithmic scale? Yes, it would, and it is possible to do so. It will not change the cycle analysis, but from the visual point of view, the log scale will change this. In the scanner, there is a way to do this where you can For example, let's drill in here on the ARKK Innovation Font. There is the log scale on-off switch, which will do this. And you're right, I would recommend even to do so. So then another question, we have two possible ways to use at the foundation. One is the basic, which is the basic membership. And then there's a so-called analyst version, which gives you, or the basic difference is, in the analyst version, you are allowed to analyze intraday data sets. That's one main difference. The basic cycles app, the basic, just allows for daily or higher time frames. If you're interested to upload your intraday assets, then you need the analyst version, because the analyst version allows you to analyze intraday data set. That's the first point. The second point is there are some features in the applications which are only available to analysts. For example, we have an auto composite feature, which is called the, you see it here in the nominal cycle nearest fit, NCNF, nominal cycle nearest fit, which allows you to do auto composite, so build a composite out of the detected cycles, which means you select 1, 2, 3, 4, 5 cycles to build a composite model. And the nearest cycle nominal fit means you can define a nominal model like the Hurst nominal model, and the cycle scanner will automatically select the real cycles which fit into the Hurst model or your nominal model you have defined. And this is open, you can define whatever nominal model, not just one. So this is another feature. And then there's the harmonic analyzer. So there's also the harmonic cycle analyzer, which shows you the harmonic relation between different cycles, which is also only available in the analyst version. And last but not least, you have more slots to upload more data sets, to update more data sets, and you can configure your selections with more individual assets which show up in your dashboard. So just that's in a second or in a minute, just the explanation between these two. And I think that's the same question, Brent, in this direction, which ARKK has. And I think I will make a separate episode to explain the different levels of scanners. So I think today I just gave you a brief explanation, but I will take these questions, Eric and Brent, to my notes, and we'll record a special session on showcasing the difference between the basic membership and the analyst membership. And I promise to do this within the next 4 weeks. So at least by mid-August, I don't know the exact point in time, I will release a video to showcase the difference here. I think it will take too much time to explain every difference. What is the policy regarding sharing scanner results outside of the cycles membered? If okay, what is the easiest way to do it? So first of all, yes, we would like if you share the cycle scanner results. The screenshots, pictures, share them. Explain the world what you have done. Just reference the Foundation for the Study of Cycles that you use the tools, but you are free to share your pictures, and it's not required to reference the Foundation. I think it's good common sense to give the source or reference the source, but you're not allowed. And we would recommend that you share your analysis out to the world. That's the purpose of the Foundation. So please share, please do so. What's the easiest way? There are two simple ways. So first of all, you can always save a screenshot or a picture of your current analysis. Here in the upper right corner of the cycle scanner from our tool set, you can save the workbook. And save the workbook means that you will directly receive this graphics as a file. So there's a link, so you can share the screenshot. This link is now static and available, And this gives you the direct link to a picture. So you even don't need to do a screenshot. Yeah, the picture is automatically saved and you can share this link. You can embed this link in your blog post you're doing on your own blog, or share this link with anyone. For sure, I mean, this makes no sense. So for example, if I add now this cycle here, and now save this workbook, you will see that you have now saved this picture with the cycle composite forecast here as a screenshot. So it's as easy as that. You can directly create the screenshot out of the application. The link is there. You don't need to download or upload it anywhere. You can directly use the link, put it in your blog, in whatever email you want to share with friends. So that's the way how to share it, and please do so. If you want to send me an update where you shared, I would always be interested in. So Eric, another question in regards to the correlation coefficient in the left part of the Cycles app. It's based on the Fitch of the and the price Fitch. So first of all, Fitch was just a misspelling in this session by myself, but I just like the phrase. So Fitch was generated by fit and match. So if you cross fit and match, it gives you Fitch, but that's just the fun part. The important part is the correlation question here, which you are talking about, and this is the mathematical way to calculate correlation. I will show it and share it with you. In the upper left section here, you see two values, and these are two correlation values or correlation measures. And this is the correlation between the composite, so the pink composite generated out of these three selected cycles, and the real price data. But this correlation takes into account amplitude, absolute price, and timing, as this is the mathematical composite. So, you can zoom in and out. So the left value will not change, but the right value might change. So here, if I've zoomed into this period, you will see a very high correlation of 0.9, which is very high, and this right part of the story, this right part of the value here is the correlation of the visible data. And you see here that the composite and the raw data, it's close to 1. It has a perfect correlation. And if you zoom out, you see that the right-hand correlation gets worse, 0.6. And you see, because here the price and amplitude is more out of sync. So the overall visible range here gets even more bad. But that's not the Fitch score. So maybe I need to work, or I will work on the Fitch score, because that's more important. And the correlation might be misleading, as said, because we are just interested in the timing and not the absolute price projections. The Cycles energy chart, which you might have seen today, it's another topic, it's another subject. It's not visible to members, so this is a special feature I'm using. I will evolve more on that feature as we move more into the future in the foundation. So for sure, we are working on additional features. They are not released yet at the foundation. So please wait until we reveal that. So last but not least, as we are running for a long time, for MACD and stochastic, I have to put in 2 periods. The long period is half of the dominant cycle, but which should I choose for shorter period? Harmonic, thank you. Yes, good point. This question is related to one of the topics I often outline here, so that you can use the length of the dominant cycle to fine-tune your technical indicators. Yes, that's another feature of the cycle length. And you should always use a harmonic of the detected. So if the long period is half of the dominant cycle in that case, then you should third or fourth of the cycle. So in harmonic, if you use half of the dominant cycle for the longer term period to tune the stochastic, then use a third or a quarter of this overall cycle length as a shorter term period. And then you have a very good rhythm of your stochastic or MCAT, MACD technical indicator on the price chart. Okay. Dan, does it make sense to push the correlation coefficient to higher levels by taking more and more cycles? Yeah, the point you're making is you can select more and more cycles from the list of detected cycles, and this will automatically push up the correlation score. But to be honest, that's the nature of the way how we analyze cycles. So if you select all identified cycles, then you will have a correlation score close to 1. But that's every time the case, because this is how frequency and digital signal processing work. It will break down the whole data set in all possible cycle combinations you can think about to rebuild the data set. So from a mathematical point, it will push the correlation towards 1. From the point of what cycles should be used for cycle analysis and projection, this is not a good practice to do so, because I always try to explain which cycles to select for projection into the future and which cycles not to select from the spectrum analysis into the future. So therefore, I like your question, because that's the difference between just using pure math and pushing the correlation using more and more cycles from the spectrum, which will not help. I mean, it looks good on the left part of the chart. So from an historical point of view, it will look perfect, but it will not work, because you need to understand the strength of cycles, the statistical significance of cycles, the separation in the spectrum. Is it a sharp peak? It is a flat peak, plateau. So these are additional measures which are not directly in the spectrum or the digital signal processing analysis. And that's why I try to explain here week by week how to select the right ones for projection. Because to end the answer now to your question is, in the end, often you don't need more than 3 dominant cycles to have a great projection, even though mathematically you can add up 10 to have a perfect correlation. But one of the important points in cycle analysis, learn what cycles not to use in forecasting. That's something we need to learn. Detect cycles in the past is easy. Yeah, that's common sense. The algorithms are out there. Everyone can do this. The key is now to have knowledge and understanding what cycles not to select from a mathematical analysis and which cycles to select. And that's, maybe it's a good ending here for today. That's the purpose of why we're here at the foundation. And that's the purpose I want to drive really here our weekly cycle analysis, because I think there's so much to learn and there are no gurus, just cycles. Okay, that's it for today. Thanks for joining me. Please like, subscribe, and please join me next week. Same place, same time, Monday, your weekly dose of Cycles TV. Thanks for joining me today. See you next week. Have a nice evening or day. Bye.